The most dangerous moment in any bull market is not the crash itself, but the deceptive calm right before the storm. It is the period when the music is loudest, the gains seem easiest, and a handful of market darlings are paraded across the ticker as proof that a new era of permanent prosperity has arrived. The public sees the generals clad in shining armor charging to new highs, and they mistake the celebration of a few for the strength of an entire army. They do not see what the professional sees. They do not see that the soldiers, the great mass of stocks that make up the true market, have already stopped advancing. They are tired, they are wounded, and many have already begun a quiet retreat. This divergence, this fatal disconnect between the leaders and the rank and file, is the most reliable precursor to a major market decline I have ever witnessed. It is the telltale sign that the end is near. These are not new ideas invented for a new time. They are the timeless laws of market behavior, paid for with my own fortune, lost and remade, time and again. I first recorded them in the pages of Reminiscences of a Stock Operator. If you wish to understand the foundations of this thinking, to see the raw stories from which these laws were forged, you will find the link in the description of this video. But be warned, reading is not enough. You must learn to see the market not as a collection of individual stocks, but as a living, breathing organism whose health is revealed not by its loudest members, but by the vitality of its whole. This is the science of reading market breadth, and it is the key to your survival. The average speculator is blind to this. He is fixated on one thing, the stock that is moving. He reads the newspapers, he hears the tips, and his attention is drawn to the spectacular performer of the day. He sees radio or anaconda copper making new highs, and believes the entire market must be sound. He is like a man attending a grand parade who only watches the drum major, ignoring the fact that half the marching band has collapsed from exhaustion behind him. His focus is too narrow. He mistakes the symptom, a soaring leader, for the cause, which he assumes is a healthy market. The reality is often the exact opposite. An exhausted bull market in its final stages pushes all of its remaining energy into a few well-known leaders. This creates the illusion of strength while masking the widespread internal decay. It is the market's greatest deception. I saw this with my own eyes in the summer of 1929. The public was delirious. It was a new era. Everyone was an expert and profits were a birthright. Chauffeurs and shoeshine boys were dispensing stock tips as if they were old hands at the game. The popular favorites of the day were being bid up to absurd heights. But when I looked at the tape, what you would now call your live market feed, I saw a deeply unsettling picture. For every well-known leader making a new high, I saw 5 obscure workaday stocks that were failing to advance. Many were already rolling over, breaking below the support levels they had built over months. The army was in disarray. While the newspapers printed headlines about another record high for the industrial average, the tape was telling me a different story. It was whispering a warning. It showed that the buying was not broad-based. It was concentrated, almost frantic, in a few dozen names. Money was being pulled out of hundreds of secondary stocks and funneled into the last remaining leaders in a final, desperate attempt to keep the game going. This is not the sign of a healthy market. It is the sign of a market on life support with all the blood being pumped to the head while the limbs grow cold. The novice sees the headline and buys more. The professional sees the divergence and sells his line. He sells not because he has a hunch, but because the evidence on the tape is irrefutable. The market is lying, and its own internal action is betraying its lie. Therefore, the first and most crucial rule of identifying a market top is this: never trust an advance that is not confirmed by broad participation. A market that narrows is a market that is preparing to fall. The fewer stocks that are carrying the index higher, the greater the weight on their shoulders and the more certain their eventual collapse. You must learn to look past the headline number of the Dow Jones or the S&P 500 and ask the critical question: How many soldiers are truly following the generals into battle? You can measure this today with tools I never had, such as the advanced decline line, which simply plots the number of advancing stocks minus the number of declining stocks. If your index is making a new high but the advanced decline line is making a lower high, you are witnessing the very divergence that foretold the crash of 1929. The army is thinning. The advance is a sham. It is time to become cautious, to reduce your exposure, and to wait for the tape to confirm the impending weakness. The second law of market breadth flows from the first. You must analyze the market in groups. A stock does not exist in a vacuum. It belongs to a family, an industry. And just as a family shares common traits, stocks in a group share a common destiny. Money does not flow into a single stock. It flows into a concept, an industry, a sector that has captured the speculative imagination. In my day, it was the railroads, the steels, the coppers. Today, it is your technology, your financials, your energy stocks. The principle remains unchanged. A genuine bull market is marked by leadership that rotates from one strong group to another. When the railroads have had their run, the money flows into the steels. When the steels become tired, it moves to the industrials. This rotation is the sign of a healthy, vibrant market with a deep and abiding source of buying power. The danger signal appears when this rotation stops. It is a sign of exhaustion. The market loses its ability to generate new leadership. Instead of money flowing to a fresh, emerging group, it retreats to the old, familiar leaders, the generals. This is a defensive move, a sign that speculators are becoming fearful and are crowding into the few stocks they still perceive as safe. You will see the leading technology stock make a new high, but when you examine the other stocks in its group, the secondary, less famous names, you will find them lagging badly. The leader is advancing alone. This is a condition I came to fear. When I was studying the tape, I would see a powerful move in U.S. steel. My first instinct was not to buy U.S. steel, but to immediately check the tape for the action in Republic steel, in Bethlehem steel, in Crucible steel. I wanted to see if the lieutenants and the captains were following the general. If they were also strong, if they confirmed the move with their own advances, then I knew the buying was legitimate. It was group action, and it was a signal that the line of least resistance for the entire sector was upward. But if U.S. steel rallied alone, while its brethren did nothing or even declined, I would not touch it. I knew that such a move was a trap. It was either manipulation by an insider pool to distribute their stock to an unsuspecting public, or it was a final, gasping rally on fumes. Your task is to apply this same logic today. Do not be mesmerized by the spectacular advance of a single stock. Immediately investigate its sector. Is the entire group moving, or is this a lone wolf? If the leading electric vehicle company soars, but the battery suppliers, the charging station companies, and the other vehicle manufacturers are weak, then you must distrust the move. The market is telling you that the conviction is not there. The foundation is cracking. The second rule is therefore an extension of the first. Distrust any move in a market leader that is not confirmed by the action of its sister stocks. A general who charges without his lieutenants is not leading an attack. He is committing a foolish act of desperation. His defeat is not a matter of if, but when. And when he falls, he will bring down the morale of the entire army. This leads us to the third and perhaps most subtle form of breadth analysis, watching the behavior of the laggards. In any market, there are leaders and there are laggards. The leaders are the strong, innovative companies that are the first to make new highs. The laggards are the weaker, poorer quality stocks that trail behind. The mistake of the amateur is that he is often drawn to the laggards precisely because they are cheap. He thinks he is finding a bargain. The professional knows that a stock is cheap for a reason. The smart money does not want it. But these laggards serve a vital diagnostic purpose. Think of the market as a rising tide. In the early and middle stages of a powerful bull market, the tide is so strong that it lifts all boats, from the grandest yachts to the leakiest dinghies. The leaders move first and fastest, but eventually the speculative fever becomes so widespread that even the low-quality forgotten stocks, the laggards, begin to rise. This is a sign of late-stage euphoria, but it is also a sign of a market that is still fundamentally healthy, with a broad and deep reservoir of buying interest. The gravest warning sign of all is when this phenomenon ceases. The market averages may still be rising, carried aloft by the handful of generals. But you will notice that the laggards, the speculative and low-priced stocks, refuse to participate. On a day when the S&P 500 is up 1%, these stocks are flat or even down. This is the market's way of telling you that the speculative capital, the fuel for the entire bull run, is being withdrawn. The most risk-tolerant buyers are leaving the game. They are selling their speculative holdings and either moving to the perceived safety of the leaders or more likely moving to cash. When the marginal stocks refuse to rally, it means the public's appetite for risk is saturated. The pool of greater fools has run dry. The smart money, which has been distributing its holdings for weeks or months under the cover of a rising index, is now accelerating its selling. They are no longer able to unload their shares in the leading stocks without causing a price drop, so they are selling whatever they can, and the weakest stocks are the first to be abandoned. The refusal of laggards to participate in a rally is the canary in the coal mine. It is the quiet, almost invisible signal that the financial oxygen is running out. So the third rule is to periodically check the pulse of the weakest parts of the market. Watch what the most speculative, high-risk stocks are doing. If they are diverging negatively from the broader market, the end is closer than you think. When the weakest soldiers of the army begin to desert the field, even while the propaganda from headquarters is proclaiming a great victory, the battle is already lost. It is only a matter of time before the generals are forced into a full-scale retreat, which will quickly devolve into a rout. You must understand that the market does not ring a bell at the top. It does not send you a neatly written announcement that the bull market has ended. Its warnings are subtle, written in the language of divergence and non-confirmation. It warns you through the narrowing of leadership, the failure of groups to act in concert, and the abandonment of the weakest stocks. The public, with their eyes glued to the price of a single soaring stock, sees none of this. They are deaf to the warnings. They hear only the music of the ticker, which in a late-stage bull market always plays its most enticing tune just before it goes silent. Your job as a speculator is not to predict, but to observe and react to the facts as they are presented by the market itself. The facts of market breadth are the most important facts of all when a trend is mature. You must assemble these facts into a coherent picture. Does the index high reflect broad strength or narrow leadership? Are the industry groups confirming one another, or are they moving discordantly? Is the speculative fervor lifting all boats, or are the weakest ones already taking on water? When you see the generals charging alone, when you see their lieutenants failing to keep pace, and when you see the lowest-ranking soldiers already in retreat, the conclusion is inescapable. The army is broken. The structure of the market is unsound. It may not collapse tomorrow or the next day, but its fate is sealed. This is not a guess. It is a diagnosis based on the market's own internal vital signs. To ignore this evidence, to stay long because of hope or because a single stock is still rising, is to abandon the discipline of a professional speculator and embrace the blind faith of a gambler. And while a gambler may have a lucky day, I assure you, the market always has the last word. Protect your capital. Listen to the tape. It tells you everything you need to know, long before the newspapers understand what is happening. The truth of the market is not in the price, but in its breadth.